Good afternoon, everybody. Thank you for joining our webinar on employee incentives. Many of you probably do know us fairly well already, but for those of you that don't, we are the leading accountants and advisors to the media industry. We've got about 90 professionals that work with hundreds of media clients right across the media and creative sector spectrum, ranging from startups right through to sort of multinational private equity backed groups. We're also part of an international network called More Global, with presence in over 100 countries, and that really enables us to support our international clients in a joined up way. And actually, I mean, only in the last 2 weeks, I've introduced 3 different clients to our Hong Kong, our Costa Rica and our Amsterdam firms, which does show that despite the torrid time that agencies are having at the minute, life does go on. And agencies really are sort of moving out of that survival phase through the recovery phase and thinking about the longer term growth and strategic objectives of their business. And a survey that we carried out recently, many of you will have probably filled it out and hopefully have seen the results, but it did demonstrate that agencies really are thinking about things strategically right now, making the most of their time. So 55% of the respondents were reviewing their value proposition and 70% were reviewing the sectors that they were working with. And we're doing a lot of work with clients at the moment, doing structured half-day workshops, which look at all the critical success factors of their business to see just how well they are set up for success really in a sort of a post-COVID world, and to produce them a prioritised action plan. Because I think the danger here is that agency leaders have got so much on their plates at the moment that it's quite easy to lose focus. So as well as identifying the areas that require attention, the workshop sort of helps leaders really decide, you know, which 20% of the things are they going to focus on that's going to deliver 80% of the required change. And obviously one of the key areas that we review is employees, because of course an agency is only as good as the employees that, well, guess I know it's log on and off every day as opposed to go up and down in the lift every day. And, you know, and employees really have borne the brunt of the effects of the coronavirus pandemic on agencies, with 85% of our survey respondents saying that they're furloughed staff and about 60% saying they'd implemented pay cuts, and many of that those pay cuts being coupled with reduced working hours. So when thinking about future growth, employee engagement, incentivisation is going to be really critical to thriving rather than just surviving this crisis. So over the next 45 minutes, we will cover really the answers to questions that are most frequently being asked of us by our clients, right across the media and marketing services sectors, and questions that are particularly relevant to the current situation. But please do, there is a Q&A function. Do use that rather than the chat function, because it's much easier to deal with the questions. But please do submit questions throughout the webinar, and I will try to weave those in as well. So welcome to Ian and Mike. Ian is a little wave there. Ian is one of our general practice partners who specialises in working with media and marketing services clients, dealing with all of their various compliance needs, audit and tax, accounting, as well as their strategic advisory needs. And Ian, again, you know, one of these people doing a lot of these advisory workshops. And Mike Hayes, one of our tax partners, who works again with media clients on employee incentives, and as well as that, he looks at lots of other areas such as research and development, tax restructuring, and transfer pricing. So welcome. I'm going to start with some questions around bonuses, because I think, you know, this is something we definitely are being asked a lot by clients at the minute. So, you know, given that in our survey 60% of agencies said their revenues are going to be at least 20% down in 2020 compared to 2019, it's quite likely that a lot of agency targets, the bonus scheme payouts, aren't going to be hit. So potentially employees are not going to be getting bonuses, but through no fault of their own. How are agencies addressing this? Because this is a really tricky one, isn't it?
It is. It is quite tricky, and I agree with you. You know, this is a fairly common problem now. You know, we're saying 85% of agencies putting people on furlough, 60% of businesses enforcing pay cuts of some sort or the other. So there are a lot of clients and a lot of businesses in the wider sector that are finding themselves in this position. I think the first thing I would say is, I think that generally most people who are working in this sector have a pretty clear understanding that it's an extremely tough time for the sector as a whole, and almost certainly for the business that they're working in. So I do think that people's expectations around bonuses there's been a fairly significant shift from what we would have been talking about this time last year. So, the fact that targets aren't going to be hit for sort of contractual bonuses, I think that's as expected. And I think what people are looking for, what employees are looking for, and what a number of my clients and the people I'm talking to are doing, are looking about what's appropriate alternative arrangements you can put in place that it is realistic based on the current situation. So, yes, we're not going to hit our bonus targets, but, maybe we can put something much more modest in place if we have a better sort of H2 for the rest of the year. So I think people understand that they can't be paid bonuses if there isn't any money to pay them. It's just a case of, as a business owner, as managing director or finance director, can we either on a discretionary basis give people a token amount at the end of the year to kind of, as a thank you for everybody's hard work. That's one option. And I think, the pound number that would be necessary there for that to really be appreciated by people is significantly lower than it would have been this time last year. My feeling talking to people is that there's not going to be much of a actually £300 or whatever, £500, whatever it is, feels like a slap in the face. I think that would be much more likely to be viewed as, thank you so much for getting us through this. We don't have a massive bonus pool available because we've got no profits. Here's a small kind of token of our appreciation. Maybe on the slightly more structured bonus schemes for really senior management that are helping you really drive that business forward, it's probably a case of, you need to sit down with those people and reassess what realistic new targets are, not to enable them to get the same bonus this year that they would have done, but maybe just giving people an opportunity to earn some of that back in subsequent years, so they don't feel as though you're just taking their money off the table now with no chance of getting it back if they really can help the business recover and drive forwards.
Yeah, I think that's right. Expectations definitely somewhat dampened. I mean, certainly talking to my clients, when they've been having these conversations around the pay cuts, they have been, well, again, I think I used the phrase in the survey write-up, kind of blown away by the support they've had for employees and the understanding and this whole sort of, we're all in it together. Employees do seem to be very supportive.
Yeah, I think that's right. And that also comes to, as a business, even if you could, do you want to be in a position where you're paying, substantial bonuses to people where, you've had to enforce furlough or pay cuts earlier on in the year? I think, and that's where the kind of messaging becomes absolutely critical, that, you kind of, employee engagement levels in this sector have never been higher, as you've said, because everyone does feel like we're in it together. And I think as long as you're kind of, acting in that spirit and communicating that effectively with your team, you should be okay. But as ever, with any sort of bonus scheme, the communication and the messaging is absolutely critical.
Yeah, I would definitely agree with that. And what about the flip side? So what if you've got a bonus scheme that's linked to something other than revenue and profits, and it's going to kick in, but actually you just haven't got the cash to pay it out? That's a bit more tricky, isn't it?
Well, it is a lot more tricky. And, hopefully we don't have that many people on this call that have got webinars, certainly not clients, hopefully, that have got bonus schemes that have been structured in such a way that you're staring down the barrel of a significant payout without the profits to do it. And in truth, your options are somewhat limited. If people have a contractual entitlement to a bonus, or you know, even if it's not in their contract, if it's been something that's formally sort of agreed to, you know, that would be treated as contractual. You're really in a position where you're sort of relying on their goodwill probably to be able to renegotiate that. And I don't think that, you know, that's an impossible conversation, particularly if you give people an opportunity to earn that back, and then maybe some more in future years once you know, once the business has had a chance to get back to where it was and press forward. But in terms of you sort of unilaterally reducing people's bonuses where they've got a contractual entitlement to do that, that's pretty tricky. And certainly I'd say, you know, you need to be taking some pretty serious advice from Amy Cretin or, you know, one of our other HR consultants as to, you know, what you can do there. But certainly your options are unfortunately going to be limited.
Absolutely. So I've had a question coming from the audience. So they're asking, you know, generally speaking, is now a good time to be redesigning their bonus structure for the future, for sort of a post-COVID world? And if so, what are the key things that they should be thinking about to make sure, you know, we don't come across some of these problems going forward?
I mean, yes, definitely 100%. Like, you know, don't waste a good crisis, or whatever the phrase was. Now is absolutely the time where, you know, you should be thinking about whether what you've got in place is appropriate. And even if it was appropriate for kind of pre-COVID, is it appropriate for the kind of situation you're in now? You know, particularly if you're in the category we just talked about, where you've got a bonus scheme that's chucked out really bad outcomes that you weren't expecting. You know, I think the key things that you need to look at moving forward are, from the company's point of view, whatever it is has to be tied to performance somehow. So you absolutely have to avoid designing a scheme that pays out when there's no profit. And if that's, but on the flip side of that, you have to keep people's bonuses or the bonus scheme tied to things that they can influence. So, you know, if you design a scheme that was purely paid out to some people a percentage of the profit of the company, first of all, you'd have to give them visibility on that profit. But also, if that number's massively outside of their control, because, you know, they're not in charge of the costs in the business, then that potentially becomes demotivating for those people, and may either not reward them even though they have made a meaningful contribution to the profit of the business, or conversely may end up rewarding them when actually they haven't made that contribution. So even if it's not profit, I think it's important that your bonus scheme is tied to people's behavior and performance that influences profit. So, you know, the financial contribution that what they're doing makes to the business. So we most obviously see that with salespeople, where if they're selling a rate card, then that clearly has an influence on profit, and you can reward people directly on sales. For some team managers, it might be, you know, over servicing, or, you know, being able to sell more services and projects to existing clients. There's things like that aren't necessarily just tied to the profit of the business, but are clearly linked to profit and contribution. I would think that's probably the number one thing to consider, along with, obviously, it has to be something that's actually going to motivate and incentivize your employees. Otherwise, you're just giving money away.
Yeah, and I think as well, I would add that, you know, one of the problems we've come across a lot in the past is schemes just being too complex. So complex that people just don't understand them, and if they don't understand, they will not be motivated by them.
Yeah, like I 100% agree with you, and it's ironic, I think, in many ways that we're, you know, most of the people on this call are working in communications businesses, but, you know, this is an area where firms in this sector consistently let themselves down with, you know, overly complex schemes that are not as well communicated to their team as perhaps they might be. And as you say, people either become demotivated, or maybe less than that, but just don't understand.
Yeah.
If people just don't understand the scheme, they will gloss over, they'll do exactly what they were going to do before, and then you're just paying out a bonus or not, depending on what happens. You're not actually you're not driving behavior that increases the profit and the value in your business, which ultimately is what you should be trying to do with an incentive scheme.
Yeah, absolutely. But what about sort of other ways of incentivizing people then? So given that agencies are probably going to be short of cash, what other sort of softer, less cash intensive ways are there of incentivizing people?
Yeah, I mean, we've done quite a few surveys on this, Esther, as you know, obviously.
As I know. I know the answer to the question, but
everybody else. Yeah, no, we have done some surveys on this. Admittedly, not one sort of post the start of COVID, but there are the usual things that you'd expect. So, sort of more holiday, private health insurance, gym memberships, those sorts of things. I think of some of the social clubs, that kind of thing. I think a lot of those, perhaps in the current environment, are less and less relevant. I think what does become a bit more interesting for people than perhaps it was previously, and this is a tiny bit morbid, are things like private health insurance, group death in service, group life cover, that perhaps weren't, that are not cash benefits for the people and actually involved, but in the scheme of things for companies are relatively modest sums to provide those benefits, that I think will be much more highly valued even by teams of people who are relatively young than perhaps they would have been 6 or 9 months ago. So I think that is one thing to bear in mind. Another thing, again, coming out of the surveys that we've done, which I think is really interesting, is so this wasn't our survey, this was a much bigger survey that was conducted across the whole of the UK, which was asking both employees and employers what their key kind of motivations, drivers, decision-making criteria were for staying in the business that they were currently in. So effectively the things that help retain people the best. And there were some pretty significant differences between what employers thought employees wanted and what employees actually wanted. And two of the sort of top 5 things that were different between employees and employers were job security and confidence in senior leaders. And I think, it's pretty fair to say that those things will be even more important for employees than they were before. So, if as senior leaders in your business, you can build people's confidence in you as a leadership group and therefore where the business is going, albeit you're going through a difficult time right now, I think that has a massively powerful effect on your ability to retain those key staff. And to be honest, done properly, at almost zero cost to the business. And if you are as a firm in a position where you're unfortunately having to make some people redundant, communicating as quickly and as effectively as you can to those people that are left behind that their jobs are secure, that you've made the necessary, albeit unpleasant changes, again, that is going to have a significant impact in a positive way that people aren't looking over their shoulder, I think.
Yeah, I think leadership is really important, and as we know, times of economic crisis tend to lead to quite a lot of startups, and I think senior people being disillusioned with the way that their leaders have dealt with these particular times of crisis is one of the reasons that people think, do you know what? I don't think I've been treated fairly. I don't think they've dealt with this very well. I'm going to leave and I'm going to start up and do it all by myself.
I think that's right. And, although there's opportunity in every crisis, isn't there? So we've got across clients that I've got that are measuring their employee engagement in a structured way, which, by the way, is something everyone should do. But those businesses that are doing that are seeing employee engagement levels higher than they have ever been before. So, people are listening to what the the senior management and the people running their businesses are saying. So, you know, if through that messaging you can build confidence, you will really be setting yourself up for kind of increased retention rates and loyalty and engagement in the medium to long term from your team, I think.
Yeah, absolutely. Mike, sitting there very quietly, I haven't asked you any questions yet. So there are a number of tax breaks available at the minute, aren't there, for people that are working from home, given that most people are working from home at the minute? Could you just give us a little overview of what those are? Because I think some of them might, you know, people might not be quite so aware of them.
Okay, well, there's two main ones really. The first one, which is one we've always had, is the working from home allowance. So if you're required to work from home, you can claim a deduction for tax purposes of £6 per week. You need to phone the tax office to get that included in your coding. So there's that. The other one, which is a short-term one, which will run for this tax year up to the 5th of April 2021, is that if you're having to work from home, but you don't have an appropriate desk and an appropriate office chair to work from, and you acquire those types of things, then if the company reimburses you the cost of those, historically that would have been taxable as a benefit in kind. But for this short period, I think this was introduced back in March or April, up to April next year, that reimbursement is not going to be taxable at all. So if you do need to spend some money to set yourself up as a proper working environment at home, that can be reimbursed to you tax-free.
Okay. And actually questions come in. So given that a lot of agencies are going to be working on a much more flexible model going forward, with, say, people working from home 2 days a week, coming into the office 3 days a week, if people have to travel to the office or to a client on one of the days that they're working from home, is that then reimbursable tax-free? Because it doesn't form travel to work, because actually on those days your place of work is home. Bit left field question. I don't know whether this has been really looked at yet, but...
Well, I think at the moment your normal place of work is going to be still going to be your office. I think if you travel from home to see a client, I mean, that would normally be a deductible or claimable item. That would be fine, but not going into the office, because that's your normal place of work. I think that has not been addressed at all, and no changes have been made.
Yeah, but I suppose it's something they might look at if people go to a fully working from home model and working from home is their usual place of work. Interesting one.
But they're saving costs, I suspect, is going to be the counter argument. So, you're going to keep your fingers very crossed if you want that to change, I suspect.
Marcy, don't always let common sense and equity get in the way of their views.
Yes, exactly. So maybe moving on to share schemes then. So obviously they've long been a very popular way for agencies to incentivise their key staff, and are a bit of a must-have if you're planning to sell. So, I mean, maybe first to you, Ian, is now a good time to be thinking about putting a share scheme in place?
Yeah, I mean, I think I'd probably just refer back to the question I said earlier about, revising, is now a good time to be looking at your bonus scheme? And I think the answer to that is yes. I mean, what I would say is any sort of share scheme should form part of your overall remuneration and bonus kind of structure and strategy. I think if you're looking at, any sort of equity incentive scheme in isolation and not as part of that, you're missing a big trick there. But yeah, absolutely. So, it's more important than ever that businesses get engagement and buy-in from their employees, so that you can kind of get yourself out of, this slump or downturn, however severe it's been for your business, and really drive it back forward. So commercially, I think there's a really, really clear imperative for getting all of this stuff done sooner rather than later, so that your senior team, your middle management are all, helping you drive that business forward. I think Michael talked to it rather than me, but also I think as a side benefit from a tax point of view, it probably is a pretty good time to be doing it as well.
Yeah, well, Mike, I mean, at HMRC, are they going to be accepting lower share values at the minute?
Well, they are accepting lower share values if you can actually justify them. So it is going to depend on on the business concerned. And as we all know, a few businesses have done well out of the pandemic. So it might be the other way. But generally speaking, yes, the revenue are accepting their values. It is thought that they're accepting 30% less as a multiple. But I really think you need to be a bit more sophisticated than that and actually look at how the pandemic is affecting your business and actually go to the revenue and say, this is what, what we're expecting in the next year or so as a result of the pandemic, and base your valuation of that accordingly.
Mm. I mean, there are going to be quite a few share options around at the moment that are underwater, aren't there, where the exercise price was perhaps set last year or the year before when profits are really high, and now the value's a lot lower. I mean, what can agencies do about that?
Well, I think that what they must not do is actually just meddle with the existing option, but particularly if it's an approved option. So if you simply take an EMI option and you actually just say to the employee, okay, well, between you and me, we'll allow you to pay less on exercise than was in the original document, that will actually disqualify the option, and it will mean that potentially they're liable to income tax when they exercise. What they should be doing is lapsing the old options, which would have to be done under deed, which is not difficult, and then granting a new option at the new price, which will be agreed with HMRC. I mean, that has been done quite a lot in the past when options have gone underwater when there's been some sort of financial crisis. So it's a fairly well-worn path.
Mm. What are the downsides of doing that, though, Mike?
Well, the only downside really is that, particularly shares that you acquire under an EMI option, you can qualify for the new business asset disposal relief, or entrepreneurs relief as was, and that's got a 24-month qualifying period. So if you grant a new option and you sell within 24 months of granting of that new option, then you're going to be stuck with the ordinary capital gains tax rates, not the beneficial 10% rate. So it will set the 24-month clock, but then that really depends on, when the business is planning to sell.
I mean, one would think that if you're in a business in that sort of situation where options are significantly underwater, that it's likely you're thinking twice about the timing of an exit you might have been planning.
Agreed.
Anyway.
Yeah, I think that's right. And then in any event, probably the benefit that they will get from the reduced exercise price will hopefully outweigh any increased tax rate anyway, because it's only 10 to 20%. 20% is still a pretty good tax rate, even if you don't get the entrepreneurs relief. So it sounds like then, Mike, that it really is a case, if your options are underwater, you can't just go varying the terms of the option, crossing out and putting little assigned addendums. It really is a case of kind of ripping it up and starting again, and presumably that's going to mean going back to HMRC and agreeing a value with them.
That's right. That's 100% right.
Yeah. So questions come in saying, what if I just cancel the EMI options that I've got? I mean, I think they mean because they're underwater, and just pay some cash to that employee as a compensation. Can that cash just be liable to CGT, or would it be income tax?
No, any cash for the surrender of an option is straight into PAYE and national insurance. So the options have always got to be satisfied by the issue of shares. Any cash, and it's straight income tax. Yeah. Simple as that.
Okay. What about, because there was a lot of talk, wasn't there, around the time as to whether furloughing employees would disqualify them for the purposes of EMI. Where do we stand with that on HMRC now?
Okay, well, you have to satisfy the full-time working requirement, which is 25 hours per week on average required to work. So clearly, if you're furloughed, you're not going to, or you're taking reduced hours, you may not meet that requirement. So there has been a specific relaxation for that, so that if you cannot work because you're furloughed or because you've had to take reduced hours or unpaid leave, then that will still count as full-time working if it's all because of the virus. So that's quite a generous relaxation, which is not surprising, but it does mean that you're not going to be adversely affected if you're an EMI option holder on furlough.
That's good news for a lot of people, I think. Yeah.
Indeed.
And we've talked about share option schemes. Quite a lot of my clients have got growth share schemes where they've set a hurdle rate above which, you know, the value of a share kicks in. I mean, we're going to have a similar set of considerations around those, aren't we?
We are going to have a similar set of considerations. I mean, I think the problem is then if you've created a class of shares where the employee only participates above that value, and that value is now too high, you've then got to revisit your articles of association and maybe change the rights attachment to those shares, which clearly involves some company law issues. But you have to be careful that doesn't throw up tax issues elsewhere for people who may already have those shares, because you could end up with moving value into shares by doing that. So you have to, so that can be done, but you really have to be very, very careful about it.
Yeah.
Sorry, Esther. I was going to say, is it fair to say that, you know, notwithstanding those issues that it might throw up, that actually they are probably more easily resolved at a time when you can agree a more modest valuation with HMRC than they will be if you kick that can down the road and deal with it in a couple of years' time?
Of course.
Yeah, because quite often people will have granted EMI options, won't they, over the growth shares, and they may have been able to grant them at a nil or near to nil price at the time. So it's going to, a lot of the same considerations for EMI schemes. So generally then, Mike, so obviously we've heard a lot about the Chancellor getting the whole CGT regime reviewed. What's your view on where that might land and how that might just sort of generally impact the attractiveness of share schemes? He's got his eye on CGT, isn't he?
He's got his eye on CGT, partly because the manifesto promise said that they want to increase income tax, national insurance and VAT. So guess what else is out there that wasn't covered by that promise? Well, capital gains tax is one of those, and capital gains tax rates are very historically at their lowest ever in my whole career. So it is clearly a prime target for a change. I think there are genuine concerns about some of the reliefs and exemptions, the way things work. And I think the two areas which will potentially apply going forward is, I think it's very likely that short-term gains will be taxed at income tax rates going forward. And for those,
when you say short-term, what would you class as short-term?
Well, I mean, in America it's 1 year, but it could be 2 years. If you remember when Gordon Brown was Chancellor, before entrepreneurs relief was introduced, we had what was called taper relief. So basically your capital gains were added to your income and you paid income tax, but you reduced your gain over time. You tapered it off depending how long you'd owned the asset, and it was quicker to taper off if it was a business asset as opposed, say, to a holiday home or some other form of investment asset. I can quite easily see a return to that. But that won't adversely affect share options, because if they do have a taper element, of course, the longer you hold the shares, the more you're going to benefit. So having employee ownership of shares on a short-term basis won't be so attractive, because if you hold it for a year or so, you might find you're paying 40 or 45% tax, but maybe if you hold it for 4 or 5 years, you're back down to 10% or something of that order, which would be good. And the other area, which is really outside the scope of this talk, really, is I think the main residence exemption for your any capital gains you make on your house, I think, is vulnerable to some sort of restriction. But that's another webinar, I think.
A whole nother webinar.
Oh, no, webinar. Do you think he might attack again the lifetime limit on entrepreneurs relief or business assets taper relief?
Well, the business, well, I don't think so. So. But mind you, if he introduces a taper relief instead, then he might just abolish it, because there's another way of getting down to a low rate of tax. But we will have to see.
Back to how it was 15 years ago.
Yes.
Well, these things tend to go in cycles, don't they? Such is life. So, I mean, M&A activity generally then, I mean, it's actually holding up a little better than we might have expected. And actually we're looking at quite a lot of buy-side and sell-side mandates at the moment. But I think, one could argue that, agencies' options might be somewhat reduced at this time. So what alternatives are there to selling?
Well, I mean, yes, other than not selling, yes.
Other than selling to a network or private equity or whoever it is.
Well, clearly you can still do a management buyout, which tends to be a little bit more of a friendly deal, and price expectations tend not to be quite as high as with a third party deal, so it's normally easier to do. But in these times, it may be that management who might normally be expected to borrow some money personally and invest in a company might not quite have the appetite for it. So one of the things we're actually seeing as an alternative is selling to an employee ownership trust. And this is something that was introduced 6 or 7 years ago by the government, sort of trying to encourage wider employee ownership of shares. And it's sort of trying to encourage a replication of the John Lewis model, which everyone knows about, at least in principle. It's not quite like that, but the basic point is that if you sell your shares to an employee ownership trust that meets all the conditions, it can give you a tax-free capital gain, which is very, very attractive and obviously offsets any sort of reduction in price you might have to offer to make it a more doable deal. I mean, that's subject to quite a few conditions, which we can go into if you wish. And it also gives, if you set up a qualifying structure, the company then can pay tax-free bonuses to staff of up to £3,600 per annum, which is quite nice. But the tax-free capital gain part makes it really, really attractive for a company owner.
It's particularly attractive given they might increase the CGT rates as well.
Indeed, yes. Then it becomes even a bigger benefit. That's right.
I think one of the other things that's probably worth mentioning here is that compared to sort of previous economic downturns that we've kind of worked through, there is much less of a credit crunch and a lack of funding and finance than we've seen before. So as in previous downturns, some of these options, if they require any sort of external funding, either to management or to a trust or really to fund any sort of MBO, those options might be pretty well completely off the table. That's not currently the case. There is still liquidity in the market. It is still possible to borrow money, and given that interest rates are as low as they've ever been, at reasonable rates as well, even notwithstanding the sort of risks that are out there for lenders. So that either MBO or EOT, it is an option, even if it can't, if there's not the cash in the business to fund it, or people don't have independent wealth to fund it.
I think that's absolutely right. Although actually quite a lot of them that I've done quite a lot of MBOs in the last year actually, and I suspect there will be a lot more. But I would say probably 75% of those have just been cash flow funded, particularly where there's been a big cash pot built up on the balance sheet that an owner was hoping to get out at 10%. Actually, they can't seem to sell the business to a third-party buyer. Actually, doing an EOT or an MBO is a great way of taking that off the table at CGT rates. So anyone who's got a big cash pot at the minute and is finding it tricky to find a buyer, if your attitude to what's going to happen with CGT is that it is probably going to go up, I'd say that doing an employee ownership trust is something that you should seriously look at. Although that said, Mike, there are some sort of pitfalls, aren't there, with some potential clawbacks on the tax saving of the capital gains tax if you were to sell further down the line.
Yes, it's a generous structure, but with anything that's generous, there's lots of conditions and anti-avoidance. The main condition is that the trust must at all times own more than half of the shares, and that is determined by reference to number of shares, number of votes, entitlement to share of assets on the winding up, or share of dividends. So it's a wide test. And if the trustee's ownership falls below control, the tax saving, the capital gains tax saving, gets clawed back. Now, if that happens in the tax year of sale or the following year, it falls back on the seller. If it happens after that period, it falls on the trustees. So it's in the interest of both parties to make sure that they can, you're not going to have a problem with that. So, selling 51% to a trust is very dangerous, because if you then want to raise money or you want to grant an option over new shares to somebody, you're likely to get diluted. Now, most of the cases I've dealt with, they've been 100% sales, so the risk of that is much, much less. There are a few other conditions. Anybody who's a 5% or more shareholder can't benefit from the trust. And the other thing to bear in mind is that it's a once and for only capital gains tax relief. So if I was to own a company and sell to an EOT, if I thought I could sell 60% now tax-free and then sell the 40% later, you only get it on the first sale to the trust. So my second sale of the remaining shares would be liable to capital gains tax as usual.
Yeah, and the tax analysis for the employees further down the line isn't so good either, is it? It's really is a benefit for the sellers right now.
It's a benefit for the sellers. I mean, as a short-term vehicle, it's not that attractive. But, you know, if it is going to be the next sort of John Lewis sort of equivalent in the marketing services sector, and you want this thing to run on for a long time, then yes, it's quite attractive. I mean, it is really attractive even for employees. So, and you know, as part of it, you need to think about our employees then represented in the management as well. So there's lots of ancillary issues you have to think about. Is how the company is going to be run if it's held by trustees for the benefit of all the employees.
And we've had a couple of clients go through that process. One with advertising. I think that both of us have dealt with clients that are pretty happy with how that's panned out for them.
Yeah, definitely. I mean, for them, it really fitted with the whole ethos of being in it together and sharing the upside and the benefits. So, yeah, I mean, for some, I think it does work really well with the culture that they're trying to encourage within the agency. Well, we are nearing the witching hour. I think we badged this as 45 minutes. We've got 2 minutes to go. We don't have, just check, we don't have any further questions from the audience. So unless Mike or Ian, you have anything else you particularly want to add?
I think you've got a couple on the open Q&A. I don't know.
Well, there's one there, but I think we've already covered it. It was about the working from home and travelling. Maybe actually, Mike, you could just type an answer directly to that person.
Which is longer than no.
So thank you so much, everybody, for logging in. It's been a pleasure. Do go visit our coronavirus hub on our website. There's lots of really useful content on there. There's some recordings of previous webinars that we've done, as well as a lot of content on there about how to thrive post this pandemic. So do give that a look and look forward to seeing you on future webinars. Thank you very much and enjoy the rest of your day.
Thank you.
Bye-bye.